Welcome, everybody. We'll get started shortly. Greetings, Tom. So good evening, everybody. I'm John Ellis, and I'm the course director of Anesthesia Camp in Grand Cayman. And along with my sister, Tracy Ellis, we've produced Anesthesia CME meetings for over 30 years, going back to my days at the University of Chicago. And for about the last 13 years or so, we've produced an annual meeting in January in Grand Cayman. Our next meeting will be January 27th to 30th, 2027. You know how bad the winter's been this winter. I was just chatting with Cody, who will be talking to you in a bit. He's in Boston. You know how wicked the weather's been up north. So plan your escape. We've got a great group of faculty joining us in 2027 who are up on the screen, and we'll be adding a few more people. Paul Wishmeyer from Duke and Sachin Ketterpal from Michigan have been with us many times before. Amy Vincent from Boston Children's and Kiji Chin from Toronto will be joining us. Amy, Boston Pediatrics, and Kijin Pediatrics. Deanna Mosquera from Northwell Health in Long Island. And Ahab Farag's going to zoom in as well. We're going to talk some about AI as well. We're going to get up what's the latest in anesthesia. So please join us in 2027. So yeah, now on to this evening's event. Over the years, I've given lectures to residents on financial wellness, and that's certainly something that they've appreciated. And we've also done sessions actually at anesthesia camp on financial affairs, and those have been very well received. There's real hunger for this sort of information. So tonight we're thrilled to partner with DocWealth to bring you information about financial and tax planning. I mean, I've certainly learned that there's a lot more than just doing taxes at the end of the as you approach April 15th. Roth, they'll talk about Roth, backdoor Roth, and required minimum distributions and Medicare tax, Social Security taxes, and IRMA taxes. These are things I'm dealing with at this point in my life. And the more I had known earlier, the better. So I'm looking forward to this. For disclosure, we at destinationCME will receive a fee from DocWealth for hosting this with them, but we don't receive any commissions. We certainly hope you'll find their information valuable. We expect that some of you may choose to retain their services, but that's a relationship between you and DocWealth. We're not in the middle of that. So I invite, we have Laxman here, we have Cody here from DocWealth. I invite them to take it away. I'm going to stop sharing my screen and invite Cody to share his screen, please. And again, we're recording this, so you'll have a chance, you'll get this recording, you'll have a chance to review it should you wish. If you want to share it with colleagues, with family members, you'll have that ability. Thanks so much for joining us.
Awesome. Thank you, John, for the introduction and the opportunity. The way we're going to run today's webinar is going to be very educational focused. I know we're in the middle of tax season, and there's a lot of different tax strategies you can still optimize for 2025, but more importantly, how to think ahead and plan for 2026. So we'll kind of go through a quick background on DocWealth and then get through a lot of different tax planning strategies, what is helpful, how to implement them, and then we'll have a Q&A session. And so as you have questions, feel free to include them in the chat, and then we'll open it up for open live Q&A at the end as well. Cool. So we can go to the next slide. So DocWealth is physician founded, physician focused. Nearly everyone that we work with is a physician. We work with almost nearly 1,000 doctors across all 50 states. Founded by myself, I got my CPA, my college roommate, who is a 1099 emergency medicine physician. The main reason, we started this was because he had a hard time working with multiple CPAs, 3 CPAs in 3 years. When he spoke to many of his fellow attendings, no one seemed to be really happy with their CPA. We really built it from the physician perspective. The main pain points, I think if you go to the next slide, we'll kind of look at the main pain points. We spoke to probably close to 700 physicians on what was the main pain points you had with your tax person. Number one was slow communication. I'm sure a lot of you have felt this. And so when you're dealing with taxes, it's money, and you have to be able to make quick decisions, understand what's going on. You have busy schedules. And so we try to have a very, very fast response rate within a couple of business days at max. Most were saying it's taking 2 to 3 weeks. The other part, and the most important, is that it's important to be proactive with tax planning, because that directly correlates with how much you can deduct and save on your taxes, which ultimately yields to more money in your pocket, which compounds by the time you retire, versus just giving files, someone inputting in them, and filing. So proactive tax planning will actually generate an ROI, which is a return on investment. And then the last two, more than 82% said was, yeah, taxes are overwhelming and I need help navigating the complexities, as well as surprised by some of the strategies or expenses that you're already incurring day to day, which are actually tax deductible. And you may just not be included in your tax return as is. So we'll kind of go through all of that. So we go to the next slide. Yeah, and so, there's a few things that make us pretty unique. I call ourselves basically the Uber Lyft of the yellow cab world. We're very much in the philosophy of education. We're always cranking out educational content every week. We have an education platform where, we look at all the strategies that all our physicians are working with, and then make sure that we're sharing them across the entire group so people can learn from each other. And so it goes from the basic W-2 to real estate investing to does it make sense to do some medical consulting to 99 income, employing kids, all the way to the more advanced things of, I'm going to start my own practice. How do I do that? How do I pay my kids legitimately? Doing a cash balance plan. And so we go to A to Z in terms of that. The other part of it is we are very big on being available and being hands-on. So the entire team is diverse, from CPAs, EAs, bookkeeping, payroll, entity formation, to having big on tax compliance. And so very a one-stop shop essentially for everything you need tax related. And we focus on the tax planning throughout the year. So versus kind of end of the year, we're working on a personalized approach to what you have going on and options that you can do in the year to lower the taxable income. So next we'll kind of go through what are these strategies and what is the tax, what does the tax code offer in 2026 primarily? So here is probably where we like to start off with and just kind of showing an example of, someone last year's tax return that was a mix of W-2 and 1099. So this is an actual physician. I changed the name, but essentially they were making about $525,000 in income. 150 was in W-2, and then they were doing quite a bit of locums in 1099, generating 375,000. Their marginal tax rate, so they were hitting 37% federal and 5% in their state. So cumulative, that was 42% marginal. That means that 42 cents of every dollar they were earning, they were giving back to Uncle Sam. So what we did essentially is, given the structure, they were able to create an S corporation, do an Augusta loophole, which we'll get into. They had a kid that was 12 years old. They paid the kid tax deductible for them and put it into a Roth IRA, which is tax-free growth for them. And then a couple other key ones, like bought a real estate property, had a car, purchased a vehicle, and ultimately, in the prior year, they took no deductions whatsoever. We were able to deduct $352,000, which is close to $120,000 in cash back in their pocket in a single year. None of this is simple, and each one requires a lot of compliance documentation. But that's what is very important, is that whoever you're working with, it's important to analyze what options you have and it's done properly. So when you go and file for it, it's defendable and everything is legitimate within the tax code. So now we'll kind of dive into what is the difference, between just kind of traditional filing, strategic planning, and then we'll get into the deeper individual strategies, which Cody will kind of go through.
All right, take it, Laxman. Perfect. So, hey, everyone. So, here are some of the common tax mistakes that physicians often make. And they kind of illustrate why it's so important that you work with, a CPA, an attorney, and a tax advisor. So, the first one here is entity structure pitfalls. As I'm sure you're aware, there's rules on what type of entities can practice medicine. And so, a common trap would be, a physician is 1099 and they form an LLC, but maybe that state requires them to have a PLLC. So that type of thing happens all the time. You can run into legal issues, but also just tax issues where now you're an entity, maybe you're taxed as a corporation, and maybe that's not what you intended or wanted at all. Next up, we have kids on the payroll. This is something you might see often on like TikTok, social media. People say, hey, I'll just add my 4-year-olds on payroll, deduct my payments to them, and get a tax break. And the reality is, it's not that simple. There are legitimate strategies of employing your children. But again, if you're going to do that, it really needs to be that you have a business, they're performing work in your business, you're going through the formalities, issuing them a W-2, paying them fair market value wages, and documenting everything correctly. Because if you kind of run awry of these rules, you set yourself up for audit risk and potentially some penalties. So you want to make sure you're implementing this correctly. Timing and planning mistakes. This is a big one. People call their CPA every year on, 12/31 saying, oh, geez, I'm going to owe these taxes. What can I do? And that's just a classic example of waiting too long to plan. While the CPA might be able to pull some sort of rabbit out of his hat, a lot of the planning kind of has to be done proactively, quarterly throughout the year, making sure you're setting yourself up for success. S corp election errors. This is a big one. Another thing you might see a lot on TikTok, social media, people saying, "Hey, you need an S corp. It's the greatest thing." And there are legitimate uses for an S corp. It could make a lot of sense for you, but there's a lot of traps for the unwary, and maybe it doesn't make sense for your situation. The other classic thing we see is that, people think they have an S corp. They assume their attorney made the election. They thought their CPA made the election. And then it turns out they never even had an S corp to begin with. So that's something that comes up all the time. So it's important that, you're working with a professional on that. Multi-state tax, that's a huge one, right? You're a 1099 physician. You're working in multiple states. That could create some complexities. Maybe now you're filing in multiple states. You might just assume, oh, I'm in this state. I don't have to worry about the other states because my LLC is based in Wyoming. Well, it's not that simple. If you're working in multiple states, your tax complexity is going to increase pretty significantly. And then the other thing is just audit red flags. People decide, hey, I'm going to claim these very high expenses, but not keep the proper records. Show consistent losses on their Schedule C. These things are just audit red flags. And if you're audited, that could result in additional tax, penalties, and interest. So again, you really want to make sure you're doing this stuff correctly. Laxman, do you have anything to add on this one?
Yeah, definitely. We work with a lot of physicians, and I would say definitely in this income range, most of the tax profiles are complex. And so a lot of times you don't know what you don't know. And usually the CPA, if they don't do tax strategy or planning with complexities, they're also kind of missing out. So we've seen a lot of these are common mistakes that we've seen, with a vast majority, like one or the other. But multi-state tax is pretty common. It definitely gets complex. So understanding so you don't pay double tax, how to do the nexus. And then I would say again, making sure that everything is properly documented and compliant whenever you do a deduction is critical. Because if you do get audited for whatever reason, making sure it's compliant is the easiest way to be able to defend it and not get a red flag. Yeah, here I can just comment on this one real quick. Typically, we see 30, 40, $50,000 in deductions when we start working with a lot of physicians, and many, if there's 30 years left in their career, that compounds nearly to $3.8 million more in your pocket, and that's why it's so important because tax filing is very different from tax planning, where Cody was saying proactively every quarter, analyzing what's going on, getting ahead of it. Things change in life. The tax code changes every single year. And so if you're able to do just a marginal amount of deductions, that's pretty impactful in terms of retirement savings at the end of the day.
I could comment on this one. So unlocking potential. So in the world of medicine, you have a couple different buckets you might fall in. You could be a W-2 employee, right? You're an employee of someone. The other end of it is maybe you're an independent contractor. So you're what's referred to as a 1099 physician or a 1099 contractor. Or maybe you own a practice. You're a partner in a partnership or a shareholder in an S corporation. In that situation, you'll receive what's known as a K1. So you might hear the term, K1 physician. Um, each has tax savings opportunities, but they're a little bit different. So with a W-2, sort of the pros here is it's very simple and straightforward. You don't necessarily have to worry about estimated tax payments because you have withholding. Your employer is taking taxes out of every paycheck and remitting that on your behalf. Downside, though, is there's limited deductions. You don't have a trader business, so you can't deduct anything. You're merely an employee. You have less control over your taxes in a sense. And, for retirement planning, you're sort of limited on what your employer is offering for retirement plans. So yeah, you might be able to maximize that, but maybe you've heard about a mega backdoor Roth and your current employer doesn't offer that. So you could be a little bit handcuffed there. On the same side, maybe there's some benefits. Maybe they're doing a 401k match or something like that, or you like the simplicity. But from a tax planning perspective, you are a bit limited. That's not to say that there aren't plenty of strategies for you. So let's now look on the other side. 1099 or K1 physicians. So as I'm sure you're aware, the tax code is very friendly towards businesses. And in either situation, whether you're a 1099 or a K1, you are essentially a business. You're either self-employed or you're running a practice. And what does that mean? Well, it means you can take business deductions. Code section 162 allows ordinary and necessary business expenses in carrying on a trade or business. So you own a practice, you have supplies, you have equipment, office supplies, you're paying contractors and other professionals. Well, you can deduct all of that, assuming it's related to the business. You have an area of your home you're using regularly and exclusively for business, you could potentially be eligible for a home office deduction. One of the big benefits here is the advanced retirement plans. As I mentioned, if you're a W-2 employee, you're kind of just limited to what your employer is offering. Well, if you're self-employed or you own your practice, well, now you can get creative. Now you can design the retirement plan that you want, maybe allowing you to contribute even more in, or doing something like a mega backdoor Roth, for example. You have significant savings control. The cons, well, obviously it's going to be more complex. You're now dealing with different tax returns, income and expenses. There's no withholding, so you might need to now pay estimates. So there's additional compliance requirements. Again, way more tax savings, but there might be a little bit more work you need to do, a little bit more compliance, which is why it's critical that you do work with an experienced professional. So yeah, that you're doing everything correctly and in full compliance with the code.
Yeah, just to add on to that, 1099 gets very complex quickly because of the amount of deductions you can do, needing an entity, an S corp, the requirements with that, and the compliance. W2 is a lot more straightforward, but like as Cody mentioned, there are strategies. They're mostly investment related. The number one strategy that we see, especially in 2026, is the bonus depreciation. I'm sure many of you have heard or seen on social media about cost seg studies, short-term rental loophole. And so this year, there's 100% bonus depreciation that qualifies. So for example, if you buy a $500,000 property and it's a short-term rental, you can roughly deduct $125,000 of the property against your W-2 income. And that chips away at your highest tax rate. So if you're 37% federal and even like say 5%, 10% in state, that's almost close to $50,000 in cash back in your pocket, which is almost close to the down payment of the property itself.
So what are some of these tax planning opportunities? Well, the big one, right? You can deduct ordinary and necessary business expenses. So this could be supplies, software, insurance, tools to use for professional development. So maybe you're a 1099 physician, and you think, well, my income's my income, I pay tax on that. Well, maybe you have business expenses that you weren't even thinking about. Maybe you're paying out of pocket every time you travel to a site. You're paying for the hotel. You're paying out of pocket for your licensing fees, various supplies, your malpractice insurance, all of that. Well, you're no longer an employee of your 1099. You're self-employed, which means you can deduct these business expenses. Retirement contributions. This is the huge one. To reiterate, if you're an employee, you're kind of stuck with whatever your employer's offering. Yeah, you might be able to do a backdoor Roth, but that's quite limited. If you're self-employed or you run a practice, you have a whole new menu of retirement plan options. You can set up a solo 401k and contribute quite a bit in, upwards of 70,000 depending on your income. There's also things like cash balance plans that allow you to put a substantial amount of money in and really drive down taxable income and also save for retirement. Home office deductions. You have a place in your home that you're using regularly and exclusively for business and is your principal place of business. Well, you might be entitled for a home office deduction. So maybe you're doing telemedicine and you work from home every day and you have a dedicated office in your home using regularly and exclusively for your telemedicine. Well, a portion of your home costs could then be tax deductible. So it's important to have those discussions with your tax advisor. And then finally, entity formation and S corp. So there's a lot of reasons why you might form an entity, both tax and non-tax. There could be legal reasons, insurance reasons, but a big part of that conversation should always be, tax, right? By forming certain entities and doing it correctly, there are opportunities to save on taxes. For example, oftentimes people will form an S corporation as a way to save on self-employment taxes, or they could form an S corporation and take advantage of what's known as state pass-through entity elective taxes, which essentially allows you to shift your state tax burden to your business and then bypass what's known as the $10,000 SALT cap. So a lot you can do there when choosing an entity. So what are some of these business deductions? Well, some are probably pretty obvious. Direct expenses, again, you're 1099, you own a practice, you're a partner in a practice. Well, any of the direct expenses are likely going to be deductible. This could be your insurance, your software, your clinical supplies. Professional services, you have billing services, you're paying accountants to help out with your tax filings and tax returns. Travel and lodging, you're going to conferences, or you're working shifts at a hospital where again you're flying there, paying for a hotel overnight, eating meals while you're there. Well, that could all potentially be tax deductions. And then we see indirect expenses, and this again is based on the home office deduction. Assuming you qualify for that, you have an area of your home, you're using regularly and exclusively for business. Portion of your utilities or rent or mortgage interest that could potentially be tax deductible. So very important you have those conversations with your advisors. Just a little bit of a recap on the home office deduction and what expenses could potentially be deductible. Again, it would be the portion of your home used for the business, has to be an area used regularly, exclusively for business, or place where you meet with clients, or your principal place of business. But you could potentially qualify. So you don't want to leave money on the table there. The Augusta rule is something you might hear about a lot on social media as well. This comes from Augusta, Georgia. Basically, residents there wanted to be able to rent their homes out during the Masters and not have to worry about tax consequences. So they lobbied Congress. Congress passed an exception, basically known as the Augusta rule, which says if you rent out your home for up to 14 days a year, you don't have to recognize that income. It is tax-free income. So I live in Boston, for example. If I take off during the Boston Marathon and rent my home out, I don't have to recognize that income as long as it's 14 days or less. But a nuanced strategy here is that maybe you have an S corporation, a practice for your medicine, and you say, I could have some business meetings at my home, and I could have my S corp pay myself rent for that, get a deduction by the S corp, and then not have to recognize the income because it's under 14 days. So this is a very nuanced strategy. You have to make sure it's done correctly. There's tax court cases where it's abused and the IRS doesn't allow it. But assuming you're having legitimate meetings at your house, you're paying fair market value rent, you have a written agreement, this could potentially be an opportunity for you, especially if you want to have a location to have sort of business meetings. So definitely something to talk to your advisors about to see if it's an opportunity or not. And then building generational wealth. This is where you could really build some wealth and also save on taxes. When you're a W-2 employee, again, you're kind of, handcuffed by whatever plan your employer has. But if you're self-employed, you have some other options. You could do a SEP IRA, a solo 401k, which again allows you to contribute up to 70,000, which is it's even a little bit more now in the new year. That's a lot of money you could put into that and save for retirement. And then a very popular strategy is what's known as a cash balance plans. As you can see from the bottom, that allows you to put significant amount of money in these plans. Essentially, you are funding your own pension, but it's great for older physicians. You spent all this time in school, training. Maybe you feel a little bit behind on your retirement saving. Well, maybe a cash balance plan is an opportunity for you then, where you can put significant amounts of money in there and save for your retirement. That was a little bit more complex. It's going to be based on an actuarial table, but a very popular strategy, particularly for the tax benefits. All right, structuring your business. We talked about this earlier, how this is kind of a common pitfall. People either choose the wrong entity and run into legal issues, or they choose the wrong entity and end up with tax consequences they were not anticipating. So it's important to know your state law. Do you need a PLLC? Do you need a PC? Because that's all very important. But most basically, a single member LLC, or if required, a single member PLLC is what's known as a disregarded entity, meaning for federal tax purposes, it's treated as if it doesn't exist. So it has the liability protection, it exists legally, tax purposes, it's completely disregarded. You're treated as a sole proprietor, which is great because it's simple and very affordable to establish. There's minimal compliance requirements. You're just filing it as part of your individual return. And you can still take business expenses. You still have a trader business. And there's other things you could do. You could hire members of your family and potentially save on the payroll taxes. Unfortunate side of this is all the income you would earn, because again, you're treated as a sole proprietor, is going to be subject to what's known as self-employment tax, which is Medicare and Social Security. So what some physicians will do is they'll make an election to be taxed as what's known as an S corporation. To be clear, an S corporation is not a legal entity. It is strictly a tax classification. You can be a single member LLC or a C corporation, and you can then elect to be taxed as an S corp. But the big benefits here are the self-employment tax savings. You can save significantly on self-employment taxes by being an S corporation. You can make these various pass-through entity elections. You could potentially have enhanced retirement options. So there's a lot of benefits of an S corporation. So definitely something to consider with your tax planner is, hey, does an S corp make sense for me? So that's all I have. So I'll turn it back over to Lex with.
Yep, thanks, Cody. We can open it up for Q&A. Any questions at all, please feel free to have in the chat. I'm happy to answer those. In the meantime, if you're interested to learn more, we do a free consultation where we get some tax information and go over what strategies could make sense. You can book a call, just going on DocWealth.io, and then book a call there and find some time. And then we'll also send up like a follow-up email with details as well. But I would say that this is probably a very ideal time in terms of kind of reviewing and getting the 2025 plan or filing reviewed for any kind of optimizations, and then getting a head start in 2026 because the tax code is very highly variable with all of the updates and for 2026.
So John Ellis here. I'll kick off with the question. It's not my own situation, but given the shortage of anesthesia providers, we have a lot of people, doing 1099 work, certainly a lot more than in the past. And I just wonder if you have any sort of your observations about folks in anesthesia specifically, and also people making that transition from W-2 work to 1099 work.
Yeah, that's a great question. I would say anesthesiology is probably the most popular specialty in terms of 1099. That's the one that we work with the most at DocWealth, and then followed by ER doctors. We've seen a massive shift. Many doing W-2, doing some shifts at 1099, or then going full 1099. And the beautiful thing with this is that doing the S corp structure, typically having to drive to different locations, buying a car for business, and then Section 179 is where you can expense the entire value of the car. Say it's a $70,000 SUV, or if it's over 6,000 pounds, you can do 100% of the vehicle deductible against your income. If you have kids, like I think there was a question about how do I employ a 12-year-old on payroll. 12-year-olds are old enough and these days very tech savvy, right? And so they're able to go on computers, help with schedules, help kind of track things, clean home offices, but the important thing is that you have to have business income. You can't be W-2. And as a business, you have to have an agreement with like a W-2 payment. So they need to be issued a W-2, a set number of hours, what is their role being defined, and then as long as it's under $16,000 in a year, all of it is deductible for you. And all of it is tax-free growth investment for them. That's one of the most powerful strategies out there. But again, there's a lot of different compliance items with that I mentioned. And it's not difficult, it's just that you have to be very thorough with checking each one off.
And so is there something specific about the SUV you mentioned about over a certain weight that's then considered a business vehicle?
Yes, it just happens to be in the tax code where they very specifically say that if it's over 6,000 pounds, that it qualifies for 100% bonus depreciation in the year that it goes into service. And then obviously you want to keep it as much business related, because if it's 100% business related, then it's 100% deductible as business. If it's 50% personal, then only 50% is deductible in that first year. And so documenting those miles and that travel is pretty important.
Yeah, I guess yeah, that's always, a question taxpayers have is, hey, I have a business, like, should I buy the car personally, lease it to my business? Should the business buy it? What kind of car? How much will I be able to deduct? Um, and kind of the short answer is it depends, right? There's a lot of complexities with that. So that's something you want to discuss with your advisor of what makes sense in that situation. But, to Laxman's point, typically vehicles over 6,000 pounds do have sort of additional tax benefits, mostly because of the accelerated depreciation benefits. So definitely something to consider.
Yeah. So we have another question. Can you explain the tax savings again with a short-term rental? I can go into this. So basically, if you buy a property in 2026, it's a short-term rental, which is defined as an average stay of 7 days or less, typically what you see on Airbnb or VRBO. Then it qualifies for the short-term rental loophole. You have to be the person who's putting more hours than anyone else in terms of getting this set up and going and rented out. So active participation, which is a 100-hour rule in a year, which is not a lot. It's like 2 hours in a week. But then what you're able to do is you take whatever property you buy, whether it's a single family, multifamily, duplex, you take the value of the property. Every property is split into two parts: land value and building value. The building value has different components of like roof, tile, windows that have different depreciation schedules. Certain amount of that is you're able to front load all to year one instead of having to wait 27 and a half years, which a typical property depreciates. And so at a high level, that typically equates to 20 to 25% of a total value of a property. And so that's why so we've seen, probably well over 100 properties purchased, in the last few months, ranging from 300,000 all the way to a million plus. But that ballpark of an estimate is pretty good, 25%. And that's significant because, again, it chips away at your highest tax rate. So if you're making over 400,000 individually, you're at 37% federal tax rate. That means 37% of that 25% of the value of the property is all deductible that you keep back in your pocket. And so obviously you can do what you want with that, reinvest it, put in a high yield savings, but that is a very powerful strategy. And as we see with many physicians, buying in real estate, getting that income flow, cash flow, buying an asset is very, very popular for long-term, retirement savings essentially. So, but that's one of the big benefits of 2026 right now. We had another question. Can you go over our fee schedule? Yep. So everything is we're very big on transparency. So everything's on the website, DocWealth.io. The way we work is we keep it really simple. It's a flat fee schedule based on what kind of income structure you are. Do you own your own practice? Are you 1099 or have a mix of 1099? And are you all W-2? And so with that, typically the W-2 starts at $2,800 as an individual. The 1099 is $3,800, and this all represents a 12-month period. So for the next 12 months, including filing and all the tax planning, that's kind of the structure it works. There's a few nuances based on the complexity. Do you have multiple states? Do you already have properties or entities? And those are kind of add-ons. But otherwise, all of the planning, all of the meetings, you have with the 1099, you have like 4 quarterly meetings, and then between that, you can reach out however many times you want with any kind of questions on the platform. So we've had a lot of success, like in terms of saving multiples on that fee. But yeah, any questions on that, definitely feel free to book a time with us, and happy to kind of go through it in detail. Yes, as a 1099, you can receive the same real estate benefit for a short-term rental, W-2 or 1099. Cool. Cody, do you want to talk about backdoor Roths and the benefits of that and then mega backdoor?
Yeah, yeah, absolutely. So some of you may already be familiar with this, but basically, whether you're a 401k or a Roth, you kind of have two options. You can do traditional, or you can do Roth. Traditional is you get the tax deduction today, and then when you take it out in retirement, it's income to you and you pay tax then. Roth's the other way around. It's after tax. You don't get any benefit today, but you're putting money in the Roth and it's growing tax free. So you could go in the news. There's famous stories of like Peter Thiel was able to put a ridiculous amount of money in his Roth and it's ballooned to a crazy amount. So you can see Roth is super powerful. However, when you're high income, which most of you will be, the code doesn't allow you to contribute directly to a Roth IRA. You're phased out, or sorry, to a Roth IRA. So what you can do instead, though, is you can contribute to a traditional IRA. You won't get a deduction for it because your income is too high, so it's a non-deductible contribution. And then you sort of immediately then convert that into a Roth. So it's sort of your back door into a Roth as you go traditional first, and then you roll that or convert that into a Roth. There's also some nuanced versions of this. There's something referred to as a mega backdoor Roth, which is, certain 401k plans will offer it, where you essentially make an after-tax contribution to the plan, and then similarly, you sort of then convert that into a Roth. So again, people might use the terms loosely, but basically what you're doing is your income's too high, you can't contribute directly into a Roth, so you utilize a traditional or certain 401ks to still get money into a Roth because it could be very valuable, especially for those just starting out where your income's not that high now, but in a few years you're going to be in the highest bracket. So a lot of planning you can do there with Roth conversions in various backdoor Roths.
Great. And then we have another question. Can I build a property and receive the same real estate benefit? Yes, you can. As long as it's a short-term rental. If you're doing the real estate development of the property, then we would just need to track all those expenses, and that would add to the total amount that can get depreciated. Is there a benefit to converting my IRA to a Roth IRA if I have cash to pay taxes? Um, Cody, you want to take that one?
Yeah, and kind of as you alluded to, it's a complicated answer, right? It's going to be part of talking to your financial advisor. I don't really know all the facts, how old you are, what your rates are. So very complicated, but it could make sense for sure. Oftentimes people will do that, maybe when the market is down to minimize the tax that's going to be, or maybe when they have a low income year. So maybe kind of to Laxman's point, maybe you're typically in a high bracket, but you buy a short-term rental in 1 year, or you have a practice and you're buying a lot of equipment and you're going to generate a loss. Maybe short-term rental, cost segregation study, you get these losses that are now going to bring you down into a lower bracket. Well, that could be a prime time to try to do some conversions where you say, okay, I'll pay the income on this, but I'm going to pay it at a lower bracket and then let it grow tax-free. So let me know. So that could be a great opportunity for you there. It's also popular with people that are kind of approaching the retirement age where maybe they're starting to work a little bit less, their income's down, and they're going to want to convert just enough where they don't hit the next tax bracket. So it could make sense to do it then too. So again, a lot of planning you can do there, but it's a great question, something to talk to your tax advisor and your financial advisor about. I could take, so can you buy a short-term rental outside the US? So I mean, you can always buy it out there. And yeah, real estate still has benefits where, there's depreciation on it. But oftentimes for property outside of the US, you might not be able to get the same sort of bonus or accelerated depreciation on that. So again, it could still make sense from a business standpoint, but in terms of getting this massive tax depreciation deduction the first year, you might not be eligible. But something that talk to your tax advisor about.
Yeah, so another question. So we do everything tax related. So that's tax planning, tax filing as well, entity formation, bookkeeping, payroll. So we're essentially a one-stop shop, everything tax related. Real estate 401k. Um, Cody, you want to take that one?
Yeah. So I think you're saying like using your 401k like self-directed to invest in real estate
At least,
or
at least in the past, that was a possibility. It's not something that I've, read about in a long time. Is that
yeah,
something that still
it's
exists?
definitely yeah. I mean, and it gets very complicated too. So you'd want to talk to like a retirement plan professional, but that's something people will do is they'll try to use whether it's an IRA or 401k just to do sort of self-directed investments, so that you're not limited maybe to mutual funds, ETF. You try to invest in things well, alternative investments, real estate. So that could be great, obviously for the tax benefits because it's in a tax sheltered account. But again, it gets a little complicated. So something you would definitely want to work with your financial planner or a retirement plan specialist on.
Yeah, and I can talk to that. I've used my 401k to invest into real estate, and it is quite complex. Typically there is like a brokerage that takes fees for managing all of that. But again, it's probably a much longer convo to be had on that one. Um,
Yeah. I mean, I guess one thing you could do too, though, that you might see is people will, hey, they want to buy in real estate. Maybe they don't have the cash readily available. I mean, if you have a good 401k, you could always take a loan against it and use that for real estate. Obviously, there's rules on how much you can borrow, and you do have to pay yourself back interest. So it may or may not be a good idea, but just something to consider is, hey, by having these 401ks, you kind of have other opportunities you can use them for.
Jason asked, I don't want to be a landlord. Can I still do a real estate syndication? So to get the benefit of accelerated depreciation, if you are full time, it has to be a short term rental. You can do a real estate syndication, but it won't have the same benefits. It's passive income. Passive income cannot offset against active income, and what active means that something that you're actively involved in, like so it can't offset against your income as a physician. The short term rental makes the property and depreciation active. So then it's active is offset against active, but a syndication you would not be able to do. There are other W-2 strategies like oil and gas, investments, opportunity zone, donor advised funds, charitable contributions, private foundations. Like oil and gas is probably the second most popular. You can deduct around 80% of an oil and gas investment against your W-2. So, and these are a lot less dollar value in terms of an investment to a property. So, $50,000 investment, you can deduct around 40,000 of it in year one against. But again, an oil and gas is like a stock almost in a way. It's volatile. You don't know the actual returns at the end of the day, and so that's a risk. But the guaranteed aspect is the savings on the tax immediately. Nathan
Uh,
asks, oh, you want to add anything, Cody?
yeah, I could take Nathan's.
Okay.
Just that's something that comes up a lot. You might read about. You're right. I mean, the 70K, it is per plan, but the issue you often run into are there's rules related to controlled groups or affiliated service groups where basically the code would look and say, wait a second, these are actually sort of the same business, the same controlled group, or the same group. So in that case, it would apply per the group. But in theory, it is 70K, per 401k. Obviously, the employee side is across the board. You can only defer the 23.5 for last year across all your plans. So definitely gets a little complicated if you want multiple retirement plans, but definitely a possibility.
Yeah, these questions are great. So if anyone else has any other questions, please include them in the chat. Yes, we provide services for um, so all medical professionals, right? We have doctors, CRNAs, PAs, optometrists, dentists. It's really everyone who's medical. I would say at the end of the day.
Uh, that was a good question from Jason. The whole life, definitely a popular strategy just from a tax perspective. Oftentimes people will use that maybe as like an alternative to even a 529 plan. They say, hey, we'll use the whole life and then take out against the cash value to pay for my kid's college in a few years. Obviously, there's some great tax benefits to that. The downside is obviously they can be expensive, right? In the early years, the premiums on those policies can be a lot. And you think, well, what if I just took that extra money and instead put it in a brokerage account? I would have investment gains on that. But the benefit of the whole life is that you're essentially getting that return all in the policy, which has the tax benefits. So it is a popular vehicle, definitely something to talk to a financial advisor or an insurance salesperson on. But yeah, I mean, the cash value. The whole life policies can be super valuable, especially for saving up for paying for big things in the future.
Yeah, and we don't really focus on that one. We're big on like compliance and things that make sense. And I would say the life insurance is a strategy that we're not a big fan of personally, and so we don't do that at DocWealth. Um, and usually the returns are subpar of what you would get into other investment options as well.
And so you have next steps here. We'll call on board. Any other questions as we wind down here? I think this has been a wealth of information here, and clearly Laxman and Cody are up on what they do. I hope people have enjoyed the information that they've been able to impart. And perhaps if this is the end of the slides, maybe Cody, you could stop sharing your slides, and if folks want to come on camera and so by the way, yeah. So Waxman has just put in the chat there a Calendly link. I love Calendly. It's a great scheduling platform. So if you want to schedule some time with them and book a call, you can click on that link. And when we send out the recording, we'll be sure to include that link as well if you decide that you want to go ahead and engage with them. Let's see everybody here. We'll get the gallery view, and most of you all off camera here. I know the day is long, the day is done. You're kicking back, but we do thank you for joining us. And like I said, we'll send out the video and hope that you can share that with your friends, colleagues, family members. And again, there you have the information on how to book a call. Anybody else before we say good evening here? Well, all righty. So Laxman, Cody, anything else before we go?
No, I don't think so. I appreciate the opportunity and yeah, I appreciate it, John.
And I'll be in touch with the two of you.
Great, sounds good.
All righty, y'all. Thank you so much.
Thanks. Good night, everyone.
Good night.
Oh, hi, Thomas. Did you have a question?
Oh, no, it was good night, everyone.
Oh, yeah, good night. Great.
Thanks. Great talk.
Take care.